Hi, welcome back to Joe Blogs. In today's episode, I want to provide you with an update as to what's happening in the economy in China because we've now got some of the data for May, and you won't be surprised to hear that China's exports to the USA are crashing. If you've been following the channel, you'll be fully aware that Donald Trump, since he's taken over as president, has launched a trade war with China. Initially, he announced tariffs of 30% in respect of the fentanyl problem that's going on in the USA. He accused China of manufacturing the precursor drugs that were being imported into the USA, causing the epidemic. And then on the 2nd of April, as part of his Liberation Day announcement, where he stood outside the White House with a board showing all of the tariffs that were going to be applied against various countries, he announced additional tariffs of 34% against China. Now, China reacted to that. They said that they were going to impose a similar tariff on the USA, and the whole thing blew up. And by the 9th of April, the USA had imposed 145% tariffs on all Chinese imports. And obviously, that's going to affect the amount of goods that are being exported from China. And we've seen a 34.5% fall year on year to the end of May. However, in the month of May, there was a fall of 12% for US exports, and that followed on from the fall of 12.7% in April. So the USA, which was the biggest single market for Chinese exports, is now starting to collapse from China's point of view. And this really highlights why it's so important for a trade deal to be agreed, because we've been talking about these tariffs, and there's an element of amusement at certain times when it got to 145% on the USA perspective and 125% from China. It seems ludicrous. It's almost like a school argument in the playground, kids saying my dad's bigger than your dad and things getting out of hand. But what we're seeing in today's video is the reality of this situation in economic terms. We're seeing the impact starting to feed through on the Chinese economy. Now, before we go on any further today, I want to talk to you about NordVPN, who I've partnered with for today's video, and who are offering Joe Blogs viewers an exclusive 4 months extra on a 2-year plan. Unfortunately, cybercrime is becoming a more and more common occurrence, and it's not just you and I that are being targeted. It was recently reported that multinational telecommunications giant BT Group had to shut down some of its servers following a ransomware attack by a gang called Black Basta. So it's never been more important to protect yourself online. And NordVPN offers a feature called Threat Protection that blocks access to websites known to host malware, including ransomware. So NordVPN is fantastic for protecting you every single time you go online, making sure that people can't steal your identity or your passwords or any money from you. But it's also brilliant for opening up a world of entertainment, because it means that you can access TV shows and movies and sports events and other things in areas that you normally wouldn't be able to have access to. All you need to do is change your location and access all of that entertainment and information. And the fantastic news is that NordVPN is offering Joe Blogs viewers an exclusive 4 months extra on a 2-year plan, which you can access by going to nordvpn.com/Joe Blogs or clicking in the link in the description below. And the great news is that they also offer a 30-day money-back guarantee. And if we have a look at this chart, which shows China's exports year on year, you can see that in May, the increase was down to 4.8% year on year. And that shows a reducing trend. You can see that in March, the year-on-year movement was actually above 12%. It then fell down to 8% in April and is now down to less than 5%. And that figure is actually critical because 5% is the GDP target growth for China for 2025. So on average, it needs its exports to be increasing by at least 5%. Well, to be honest, more than 5%, because the Chinese economy is now dependent on exports. Around 40% of China's GDP is derived from its export growth. So what we're seeing here is a very worrying trend from China's perspective. And if you take a step back and have a look at that 5% line, which is just above the figures for May, you can see that since September 24, China's results have been all over the place. And they didn't have any results reported in January. And February was very small growth because of the shutdown in China, where a lot of the factories actually close for 3 or 4 weeks. Everybody goes home to their families and enjoys the festive period. And then they all come back to the factories again and start up again. So the first quarter of the year is really important. And when you're looking at this chart, you might be thinking, well, March looks pretty healthy because the export growth was more than 12%. So that's smashing it out the park. But what we're seeing here, what we saw in March and April, was actually a lot of exports were brought forward. So the USA was very concerned that these tariffs were coming. And so a lot of companies placed orders in advance of these tariffs being put into place. So basically trying to avoid the extra charges. So the results in March and April don't actually represent extra profit from China's point of view. All it is a shifting of the orders forward. So it's likely that as we go through the next few months, as we go through June, July, and August, that we will see the year on year growth continuing to fall. Now, this chart shows the year on year movement in imports. And the reason why I'm looking at imports and talking about what's going on with the Chinese economy is because China imports lots of raw materials, which it then uses in its manufacturing processes and then exports the finished goods. So, looking at the imports actually gives us a strong indication as to what's likely to happen over the course of the next 3 to 6 months, because Chinese businesses will need to order in advance, build up all of their raw material stock so that they can then produce things. And what you can see here is a very worrying situation from China's point of view, because since October 24, the majority of months have seen a year on year fall in imports. So that tells us that Chinese businesses are ordering less, they're buying in less raw materials, and so they are not gearing up for a strong second half to the year. And if we look at the trend between October 24 and May 25, you can see that the vast majority of months were in that negative territory. Only December has recorded a positive growth. And these are year on year figures. So this isn't just the monthly data. This is telling us on a rolling 12-month basis, China is buying less things than it was this time last year. And the results for May show that year on year imports were down by 3.3%. So the worrying sign from China's perspective here is that it's likely to get worse. This isn't actually anything to do with the tariffs. This is just Chinese companies not having enough raw materials, not buying enough items in to grow their businesses. And this is related not just to exports, but also to demand in the Chinese market. And we'll go on to talk about that in a moment when we talk about what's going on with Chinese inflation. This chart shows the year on year movement in inflation in China. And what you can see here is that in the last 4 months, China has fallen into a deflationary cycle. So prices year on year are now falling in China. In February, they were down by 0.7%. And in March, April, and May, they've continued to fall. And the most recent figures for May show that year on year prices are down by 0.1%. And you might be thinking, well, 0.1%, that's not really very much. It's not much of a fall. But the problem that you've got if you're a company is that if prices are falling, it's very difficult to be able to pass on any of your cost increases. In fact, it's impossible. And we'll go on to talk about what's going on with producer prices in a moment. And the reason why this is concerning from the Chinese authorities' point of view is because the reason prices are falling is because there isn't much demand. We've talked about simple economics a lot on the channel. Hopefully, you're fully au fait now that when there is excess demand, if people want to buy things and there aren't enough of those things, then that means that prices generally go up. But if there isn't enough demand, if there's too much supply, too many things are on sale and nobody's really buying them, then producers don't really have a choice but to cut prices to encourage people to buy more. And that's what's happening in China at the moment. The reason why prices are falling year on year is because there's not enough demand. Chinese consumers don't want to buy lots of things, and so prices are having to come down to encourage them to spend a bit more. And that's a problem because if you're looking to grow your economy by 5% year on year, which is what China is aiming to do for 2025, you need to have lots of healthy demand in your economy, lots of things that people want to buy, so that prices generally then will go up. So this graph here is telling us that there is a problem with consumer demand, domestic demand in China. And as we've just talked about, there's also now a problem with export demand, so external demand. So, from China's point of view, it's a double whammy. They're seeing their home market contracting as well as their export markets. And if we have a look at what's going on a monthly basis, you can see that the most recent data for May shows that month on month, sorry, not year on year, prices have fallen by 0.2%. So they're down by 0.2% compared to where they were this time last month. So year on year prices are down by 0.1%, but in the month they're down by 0.2%. And that tells us that the problem is getting worse. If we look at the situation since October, you can see that in 5 of the months we've had negative month on month movements in prices. And where we've seen positive movements, it's only been 0.1% in April, and we had 0.7% in January, following on from 3 or 4 actual really bad months prior to that. So the overall trend here is downwards. So what we're seeing is that there's an acceleration in the month on month contraction in prices. And the reason for that is that lack of consumer demand. And the problem that this is now causing for Chinese companies is that they're having to cut their factory gate prices. This chart shows the year on year movement in producer prices, also referred to as factory gate prices. So the price of products as they're leaving Chinese factories. And you can see that in May, the latest data, there was a year on year fall of 3.3% in producer prices. And that was actually the biggest fall that's been seen at any point in the last 12 months. And in fact, this is the biggest fall for around 2 years. And if we look at the trend here, since February, there's an increasing reduction in producer prices. So the amount that companies are having to cut their prices is actually increasing every single month. And that tells us the Chinese companies are now in a very difficult situation, because if your costs are going up, if you're paying your people more, which they are in China, they'll be increasing wages. And if you're having to pay more for things like electricity and fuel and raw materials, which they will be because there is global inflation at the moment, you're not able to pass on any of those cost increases in your end sale price, because your prices are actually falling year on year. So this is a double whammy. You've got prices going up. Sorry, you've got prices coming down at a time when costs are going up. And what that means is this gap in the middle, which should be the profit, is actually the loss that Chinese companies are making. What you want is prices going up, costs going down, and make a big profit. When it's the other way around, you're making a big loss. And that's a real problem, because year on year, month on month, these losses are getting larger. And unless you've got huge cash reserves, you won't survive as a company. The only other option you have is to take on more debt to fund your losses. But that becomes a very vicious circle quite quickly, because you have to pay interest on that debt. You probably have to pay some repayments on the debt. So that reduces the amount of free cash that you've got at a time when you're having to fund your losses. So if you start doing that, it's a little bit like people who start borrowing on credit cards and then taking out a new credit card to pay back the other credit card. And all of a sudden they've got interest on interest, and you can find yourself in a very tricky situation. And that's exactly where a lot of Chinese companies are at the moment. Just to put things into perspective, because I think sometimes it's easy for me to sit here talking about prices are going up and this is happening with inflation. But to give you a real life example that's a bit easier to get your head around, I thought it was worth talking about what's going on with Starbucks in China, because Starbucks has got lots of stores all across China. And at the moment, there is a price war going on in the coffee segment. And this is obviously bad news for Starbucks, because they're under pressure to cut their prices. But it was recently announced that Starbucks weren't intending to cut their prices. They were operating a clever way of cutting your prices without actually changing your headline price. Because if you go into a Starbucks and maybe it's $4 for a coffee, and then the following day it's cut to $3.50, you think, great. You then wouldn't be happy if you went back in next week and found that it was $4 again. Nobody's happy with prices moving around on a daily or weekly basis. But you can actually adjust your prices quite cleverly by offering coupons. So they might be freely available to get hold of. So you just go online, click on the code and maybe show it on your phone and get a 10 or 20% discount. And this is what Starbucks were doing recently. They said they weren't going to cut their prices. They were just going to offer some discounts for a short period of time whilst the trade and price war went on, and then they'd go back to their normal pricing. However, it's now been announced that Starbucks, that isn't really working. Starbucks is losing too much business. And so they're now having to lower their prices. And this tells us that there are serious problems in the Chinese market at the moment when simple things like coffee, we're actually seeing the price being cut because coffee, generally speaking, is a little bit of a luxury item. You can make your own coffee at home. Obviously, everybody's always done those analysis when you're telling people to save money. You say, cut out that daily cup of coffee, and by the end of the year, you'll have $500. And if you invest that into the stock market and it goes up 1,000,000 times, then you'll be a billionaire. I'm sure we've all seen those videos. But what we're seeing in reality here is that Starbucks is having to cut its costs in order to keep its business. So when people are cutting back on their daily spend of a coffee, it tells you that consumers in China are quite cautious at the moment. I thought this table here would be of interest to you, just as a quick comparison. It shows how Starbucks compares to the other main coffee brands in China in terms of pricing, and also we'll have a look at the impact of that discounting. So you can see that if we talk about an Americano and a latte, two of the most popular products, don't know what your favourite is. I prefer a latte. I'm not really big on cow's milk, so I prefer a coconut milk latte. Don't really like soy or some of the other offerings, but coconut milk latte, that would do me nicely. Anyway, Americano, if that's your favourite tipple. You can see that Starbucks, their list price, which is shown by the grey bar here, the list price is 30 Chinese yuan. And the exchange rate to the US dollar is around about 7.2. So that's coming in at just over $4 for an Americano. But if you look at how that compares to the competition, Manna Coffee are selling the same product for 15. So that's half the price. I mean, that is a big difference to Starbucks. K Coffee are selling theirs for 18, also a significant discount. Looking Coffee, who, if you follow the channel, you'll know that I've made a video about Looking Coffee, which was actually a company that listed on the stock market in the USA. This was a startup coffee brand that persuaded the US markets that it was worth billions of dollars. And then unfortunately, it all ended in tears. If you haven't seen that video, do a search for Looking Coffee on my channel and watch that video. It really is quite fascinating how the wool was pulled over everybody's eyes, how investors believed that this new startup coffee brand that was only in China was worth listing in the USA, and they raised a lot of money and a lot of people lost a lot of money. Anyway, Looking Coffee, they're selling their product for a lower price. It's around about 26 Chinese yuan. Cotti Coffee are selling theirs for around 23, and Lucky Cup, which is obviously at the budget end of the market, you can get an Americano for around $6.50. So that's almost 5 times less than the Starbucks offering. But if we look at the blue section here, this shows us the price after the discounts that are now being offered. So Starbucks, the reality of the situation is that nobody's wanting to pay 30 Chinese yuan for an Americano. And so with the discount, you can pick it up for around 18. So that's almost half price. But everybody else is also in this game, apart from Lucky Cup, who don't need to discount their coffee because it's so cheap anyway. But you can see the blue sections here for Manna, K, Looking, and Cotti have also reduced their prices to around 3/4 of what their headline price is. And in fact, Looking Coffee, it's less than half of their headline price. So even though Starbucks is offering these discounts, they're still more expensive than everybody else in this market. And what this tells us is that there's a price war going on. These businesses are competing heavily on price. They're cutting their prices. And the reason for that is because there is a reduction in demand in China. Consumers are cutting back on things. They're not spending as much. They're more cautious. And things like a daily cup of coffee is something that's really quite easy to cut back on. You can find other things to drink. You can make something at home, whatever, drink some water. And they're now struggling, these coffee chains. And coffee is usually an acid test as to what's happening in the market. When an economy is doing well, then people will feel a bit more affluent. They'll be happy to spend $5 on a coffee every day, makes them feel a bit happier, a bit more wealthy. You can be seen with your Starbucks cup walking around, and everybody thinks, hey, that guy's doing quite well. He's drinking Starbucks. But when the reverse happens, when people start to worry about money and maybe cut their budget and tighten the purse strings, that's one of the first things that goes out of the window. And that's what we're seeing here. And this could be a really strong indication that the Chinese economy is in difficulty. If people are pulling back on this discretionary spend on coffee, it tells us that it's going to be really difficult for China to achieve that 5% growth target for 2025. So, what's the summary and conclusion today? Well, I wanted to post this video because we've been talking a lot about the tariffs between China and the USA, and it almost became a story in itself, just seeing how high those tariffs could go. But what we've seen in today's video is the reality of those discussions on the actual results for the Chinese economy. And we've seen that year on year, exports to the USA, which is the biggest single market for China, it's the most important market, the most lucrative, it's where it earns a lot of its profit. They're down by 34.5% year on year to May. And this follows on from the fall in April. And we're seeing a fall of around 12% every single month at the moment. Now, looking forward, it's likely that the situation is going to get worse because, as we saw from the data, there was actually a ramping up in exports in the couple of months before all of these tariffs kicked in. The tariffs really hit hard in May, and they're still continuing at the moment. There's this 90-day pause period while the two sides are negotiating. But we've still got a 30% tariff that's remaining in place from the USA. Plus, there are tariffs on things like steel and aluminum and lots of other different products. So we've still got more tariffs now than we had a few months ago on Chinese imports. But one of the biggest problems that Chinese companies are facing is the uncertainty, because until that trade deal is agreed, until something is signed that's permanent, nobody really knows what's going on. So US businesses are now in a state of flux. They basically don't know what to do, whether or not to place an order that could take 3 to 6 months to be delivered from China. What you don't want to do is place that order for $1 million worth of equipment or $100 million worth of goods, and then find that before it's landed, something else has happened with the tariffs, and you now have to pay a 50% tariff on all of those goods when they land at the US port. So that uncertainty is holding back trade. It's causing everybody to sit on their hands and wait and see what the final outcome is. And that's going to represent seriously bad news for China. We've started to see it in May. We've seen the trend is moving downwards, and it's likely to continue through June, July, and August until we get some sort of settlement. And what we've also seen in today's video is that the home market in China is also in decline. We've seen inflation coming in negative territory again. So we've now had 4 consecutive months of falling prices. That tells us that there is weak demand in China right now. Chinese consumers are not spending. They're cautious. They don't really know what's going on. So they're holding back on spending. And that is seriously bad news, not just for the Chinese economy, but also for Chinese businesses, because they are now being hit from both sides. They're seeing their exports collapsing to the USA, and they can't sell that product into the home market because all the prices are going down. They could sell it, but it would probably accelerate the fall in prices and mean that they'd have to cut their prices further, make less profit, probably make bigger losses. And we've got around 50% of the companies in China are already making losses. So more losses mean more risk, more concern about the viability of those companies. And of course, all of this is seriously bad news for the Chinese economy. And the Chinese authorities have set a target growth level of 5% again for 2025. And what we've seen in today's video is that the exports are now growing at less than that. They're coming in at 4.8% year on year. That is likely to continue contracting. We will see that growth getting smaller. The home market demand is also reducing, and this all represents seriously bad news for China and the Chinese economy. And there is a massive risk now that they won't hit that 5% growth target for 2025, particularly if the trade deal with the USA doesn't get agreed anytime soon, because That's the biggest market. China needs to get that market going again. It needs to ramp up. Obviously, Donald Trump is looking to push back on that. He wants to reduce the amount of things that the USA is importing from China. And China doesn't really have an alternative market in the short term to place all of those goods. It certainly can't sell it into the Chinese market. And if it's going to find other overseas markets, it needs to do so rapidly. So hopefully you've enjoyed today's video. You found it useful, informative, and thought-provoking. Thank you so much for everyone that's watched this video all the way through to the end, and also to everybody that's supported me. If you've bought me a coffee or sent me a YouTube super thanks, I really appreciate that. Thank you so much. And if you're a long-term supporter, either through Patreon or Buy Me a Coffee membership or YouTube membership, thank you for that support. Really helps to keep me motivated. And here's something to put a smile on your face.